Hello investors, welcome to Business Learnings. Uh, in this video, I'll tell you exactly how to construct your own portfolio, which specific stock should you be investing in. A lot of people ask me what stocks should they be investing in. In this video, I'm exactly going to tell you what should you be investing in so that you generate better returns than 99% of the mutual funds out there. And the good thing is this is not at all complicated. By the end of this video, you'll have complete clarity on how to construct your own portfolio of stocks. So please ensure that you watch the video throughout the end so that you get complete clarity. You do understand the concept first, and second thing, please subscribe to the channel so that it will keep giving me motivation to create more content like this. Let's start the video. The underlying principle that I want to highlight here is investing is easy. Don't make it complicated. It's very easy. Uh, it's extremely easy. I'll give you the example right now. So to construct this portfolio, all you have to do is think about your day-to-day life, your daily life, and think about all the products that you use throughout the day. Let's start with, for example, my life. I wake up and I check my phone for the first time. Whenever I open my eye, I check my phone. I check the notifications, messages, mails probably, and that's why I have listed down Reliance, because Jio is the network, the internet provider. That's how I get network in my phone, and that's why the company that owns you is Reliance, and that's how I listed Reliance in this list. Then I go and brush my teeth with Colgate, and that's how Colgate Palmolive is in this list. For some of you who smoke cigarettes, ITC is in the list. I have a chappal of Relaxo. I wear Relaxo slipper, and that's why Relaxo is in the list. I wear clothes of jockey innerwear, outerwear, t-shirts. That's why Page Industries in this list. I go to the bathroom, use soap, wash my clothes. That's why Unilever is in this list. I take tea and again Unilever. If for a very basic for a very basic understanding, if you are an Indian, there is a 99% chance that you must be using at least some of the products of Unilever, and that's why Unilever has to make the list. Most of us love Maggie and eat it almost once, twice, thrice. Some of us even eat Maggie every day a week, and that's why Nestle is in the list. Most of us love Domino's pizza, love to order it, and it's psychologically connected to having a good feeling of ordering something today, partying with friends, staying at home, and not cooking. Just order it from Domino's, and you'll get the pizza in 30 minutes. That's why Jubilant Foodwork. Most of us have a motorbike on their homes, and more often than not, that must be a Hero Honda, and that's why Hero Motocorp is in this list. Most of us use Fevicol, and that's why Pidilite is in this list, and most of us have a bank account, most probably in SBI, and that's why uh, SBI is in this list. So what I did here, I just made a list of all the companies, uh, these companies, the products that these companies offer. I use them in day-to-day life, in daily life. I just thought about my daily life and I listed down these companies. Now let's look at if we had created a portfolio of these 10 companies. What would it look like? What returns will it give? 5 years ago, Reliance was trading at 512. Currently, it's trading at 20,048 rupees. The returns 32% per year. Colpal 12%, ITC minus 0.2%, Relaxo about 30%, Page Industries 20%. And in these returns, I have also included the dividend, because you get the dividends directly in your bank account, so that's why you have to include it in the overall returns that you are getting. And that's how I constructed the total. That's how I constructed the total returns chart. So a portfolio of such companies, if you had 1 lakh rupees 5 years ago and you had invested 10,000 each in these companies, it would have been 2.6 lakh rupees at current value, and the CAGR is 21%. So a fund which is constructed entirely of the stocks that you know about, because these companies, the products that I have listed, we use them on day-to-day basis, and that's how we traced down these companies. The portfolio consisted of these companies gave a return of 21%. And what exactly did I do? I thought about my daily life and I listed down all the products that I use. And some of those products probably will not be listed in the Indian stock market. For example, I have a Redmi phone, a Xiaomi phone, and it's not listed in India, and that's why I have not included in this Excel. I've only included all the things that immediately came to the top of to the top of my mind. If you want to construct your own portfolio, just think about your daily life and think about all the products that you use. Trace down their companies and find out if they are listed on the stock market or not. If they are listed, just list down in your Excel. Find out their prices 5 years down the line, 5 years ago. Find out their current prices, get their returns, add their dividend yields. All of this information is readily available on Google. And take the average. 21% is the average of my portfolio, the products that I use. 14.8% is Nifty 50. You know, the benchmark, the most fund managers treat Nifty 50, the returns offered by Nifty 50 as benchmark, and we have beaten the benchmark by 6%, 6.2%. This is the kind of potential that. And what did we do? We didn't watch any TV channel. We didn't get any stock tips. We didn't consult any financial advisor. We did nothing. We didn't know anything about finance at all. All we did was just list down all the products that we use in day-to-day life and trace down their companies, right? That's all we did. And we did some basic research on what their prices were 5 years ago and what are their current prices. This is all we did. And we got a return of 21%. Now let's look at how much return other mutual funds are offering. This is Value Research Online. Most of people use this website to rate different mutual funds, to select mutual funds, and I have arranged these mutual funds. I have only taken 4 and 5 star funds, and I have arranged them on the basis of their returns, their annual returns for the past 5 years. So you see, the best performing fund has given a return of 20.53%, and there are about 2,500 various mutual fund schemes out there in India. None of them in the past 5 years outperformed, gave more returns than 20.53%. And our portfolio, a portfolio constructed by a layman who doesn't have any knowledge of finance at all, who doesn't read, who doesn't track stocks on a daily basis, he created a portfolio and got a return of 21%. Well, I understand there might be 2 or 3% up and down, but still, even if you are getting a return of 18%, that will be more than enough. Even if you get a return of 18%, you will be among the top 1, 2, 3, 4, 5, 6, 7, 8. You will be among top 10 mutual funds in India, and that's a huge thing. All the people who are managing all these 2,500 funds, they are professional managers. They get a lot of money to manage those funds, to select their stocks, and you are able to beat them. The reason is investing is simple. The more you complicate it, the more you lose. The more you complicate it, just remember this rule that investment is very easy. Just stick to the products that you understand and keep on investing on a disciplined basis. You will make a lot of money. You will beat 99% of the fund managers out there. That's what the takeaway lesson should be. Now go and create the list of products that you use, trace down their companies, and check out how much would you make. And if you are making, if you are confident that you are making a good enough return, there is no point in probably investing in investing through a mutual fund. So again, I'm not a SEBI registered financial advisor. So please consult your financial advisor, or do your own research before taking any big decision, because it's your money and you'll have to take the responsibility of carefully managing it. So that's all I had to say in this video. Thanks a lot if you have been watching this far. See you in the next video.